Well, welcome everybody. My name is Bruce Weber. Wish you a happy new year. We've got a terrific panel set up for you today, and I'm really pleased with this audience. We all know January is kind of an unusual month at the University of Delaware, but I'm really pleased how many people could come today for our panel. Let me welcome the audience. I'm welcoming the distinguished audience members, our Provost Domenico Grasso, Dean of College and Arts and Sciences, George Watson, Deputy Dean of Lerner College, Rick Andrews. Thanks for coming today. It's the beginning of a new year. When New Year's come around, we make and we try to keep resolutions. We make resolutions about our fitness, about our work and our study habits for the next year, and we make resolutions about good financial choices. So what we've done is put together a panel to explore the changing landscape of financial markets and offer some insights on how to make intelligent financial and investment choices. We've got a great panel to talk to those issues and a moderator who is very distinguished, Ralph Begleiter. Welcome, Ralph. Ralph is the director of the Center for Political Communications here at the University of Delaware. He's an award-winning broadcast journalist who I remember very many times watching on CNN and their programs. He was the world affairs correspondent at CNN and the network's most widely traveled reporter, working in 100 countries on 7 continents. I'd like to see your passport someday, Ralph. How many inserts did you have to get for that? Ralph covered U.S. diplomacy, international diplomacy, interviewed countless world leaders, and hosted the Global View program and also co-anchored CNN's International Hour. Ralph continues to travel today with UD students to countries like Cuba, countries in South America, Turkey, the Middle East, Antarctica. I want to hear about that trip soon, Ralph. And conducts a number of media programs for the U.S. State Department. He's a graduate of Brown University, and in 2000, the editors of the Brown Alumni magazine named Ralph among the 100 alumni who have had the greatest impact on the 20th century. Ralph's other honors include awards from the National Press Club, National Academy for Cable Programming, the Associated Press, and United Press International. I'm fortunate as a dean here at the University of Delaware to have Ralph as a colleague, and thanks very much for agreeing to moderate today. Ralph, the floor is yours.
Thank you very much, Dean Weber. I appreciate it very much. I'm honored to help facilitate this discussion of the investment world of tomorrow with our very distinguished guests. Our panel actually represents quite a spectrum of expertise at the intersection of the worlds of investment and public policy. They're known and respected for their investment analysis and Wall Street perspective, of course, for educating young entrepreneurs and advising Delaware business and state government affairs, and for astute observation of the political climate and public opinion context in which the investment world exists every day. I want to introduce our panelists. I'll do so more briefly if I may. I think everybody knows everyone on the panel here, but Liz Ann Saunders is Senior Vice President and Chief Investment Strategist for Charles Schwab and Company. She's a University of Delaware alumna. She's one of the most influential women in the world of finance, regularly quoted in major financial publications, and appears on major national media, including CNBC, ABC, CBS, PBS, and Fox Business News. Although I doubt many of the young people in the audience will remember it, she was a regular guest on PBS's Wall Street Week with Louis Rukeyser. At Schwab, she does market and economic analysis and investor education, focusing on individual investors. She analyzes and interprets the economy and markets and is the chair of Schwab's Investment Strategy Council. She earned her bachelor's degree from UD in 1986 and is a member of UD's Investment Visiting Committee. She earned her master's degree in business administration from Fordham University. Don Puglisi earned his Bachelor of Arts and Master of Business Administration degrees from Michigan State University and his Doctor of Business Administration from Indiana University. He joined the faculty here in 1971 and taught undergraduate and graduate courses here until 2002 about securities analysis, portfolio management, management of financial institutions, and corporate finance. During his more than 30 years as a faculty member, he was honored 6 times for his teaching, including the university's Excellence in Teaching Award. He has published extensively, and as a UD Public Service Fellow, he consulted for the state of Delaware and 7 years served on the state's Public Service Commission. He's been a visiting research scholar at the Federal Home Loan Bank Board in Washington, D.C., which honored him for his role there. And in 1973, he started his own business, Puglisi and Associates, to provide financial and administrative services. And today, Don is actively involved as both an advisor to institutional investors and securities issuers in the bond markets. Don also serves on the Investments Committee at Winterthur, and he's a trustee of a mutual fund complex as well. Paul Brewer, my colleague and Associate Director for Research at UD's Center for Political Communication, earned his PhD at the University of North Carolina, Chapel Hill. He's a professor in the departments of Communication and Political Science and International Relations. His research focuses on political communication, public opinion, especially relevant today, and science communication. He's particularly interested in media framing, citizens' uses of information shortcuts to form their judgments, and the role of entertainment media in public affairs. He's the author of a book called Value War, Public Opinion and the Politics of Gay Rights. His research has also appeared in numerous prestigious national scholarly journals. Before we begin, I just want to try something with the audience here for a minute to introduce you to our panelists. I'm going to ask you to raise your hands if you know the answer to a question I'm about to ask. But the key is, raise your hand if you knew the answer to this question before you walked into this room this afternoon. Please raise your hands if you already knew that a young hedge fund manager who is charged with illegal insider trading was kicked out of Harvard University for making up a false grade transcript when he applied for clerkships with 24 judges, and then covered it up by creating phony emails and a counterfeit report from a computer investigations company. How many of you knew about that aspect of that story before you walked in the room here today? Okay, I expected more hands than that in this audience, but we now know
Harvard Law School.
We now know more about our audience than I think than I certainly did anyway when we walked in. So to get started, I'm going to ask each of our panelists an opening question, but then I've got a stack of questions that have been collected from some of you who are here in the audience today in advance. So the first question for all of you, and Lizanne, I'm going to ask you to address this first, and Don second. Knowing that our students here today are going to be reaching their prime career periods in about 10 to 15 years, a decade, a little plus from now, and thinking back to your own experience in that arena, I'd like to ask what each of you think the main characteristic of the investing world is likely to be, or the characteristics of the world will be in 10 to 15 years from now. Now, I realize you can't cover everything, so pick a couple of characteristics that you think might be headliners for students today, not about what the world's like today, but what it's going to be like in 10, 12 years when they are in their prime and making these important decisions. Lizanne?
Sure. Hi, everybody. I hope that this translates to something that we can still be talking about to 10 to 15 years. If not, though, I will say to start off, I think the bull market we're in, at least for the U.S. stock market, that started in March of 2009, I think will be the biggest and best bull market in my career. Now, I started in 1986, so that includes the big one in the 1990s. I think what started in 2009 was what they call a secular bull market. Doesn't mean we're not going to have mini bear markets, and I'll remind you that the crash of '87 occurred in a secular bull market. But I think this is one of the big ones. I think for probably a good chunk of that time frame that you asked us to opine on, I think the U.S. will become dominant again in the global economy, also from a market perspective. However, the world in many ways is getting smaller from a market perspective. I say anybody entering into this business, which is very, very different than when I entered into my business in the mid-1980s, has to have a global perspective, has to understand markets outside of the U.S. And also markets beyond just stocks, bonds, and cash. I think everything within alternatives, there are so many other asset classes now that I think as students of this business and going into this business, even if you have a more concentrated focus in terms of what you do, you have to have that broad global knowledge and that knowledge across asset classes. But I think the U.S. is in a particularly unique position right now where we are taking back some of what we lost in the last couple of cycles, and I think it's somewhat long-lasting. If you think about the last two big more economic up cycles in the U.S., now in hindsight, we know the wealth created was more paper wealth. We had the big tech bubble and boom in the late 1990s, and then we had the housing boom in the most recent decade. And really all they did was generate a lot of paper wealth. I think the environment we are entering into now is one where the U.S. becomes a manufacturing powerhouse again, becomes an export powerhouse again. We are now the world's largest energy producer. We are probably within 7-8 years of being energy independent. We are the most innovative nation in the world, and I think we will continue to be. So what you're hearing from me is the complete opposite of what you will hear from a lot of folks out there right now that believe the best is behind us. I think we are entering into a period of innovation, manufacturing prowess, export competitiveness that is going to blow the skeptics' minds. Doesn't mean it's not without hiccups along the way and not without bear markets along the way, but I am very, very passionate about what is happening here in the U.S. and think that too many people are underestimating what we are going to be able to do.
Okay, Don?
I was hoping that the first question would be to Lizanne, and I would get the second question, which would be a lot easier than the first question, but apparently that's not going to happen.
Sorry.
If I were asked this question 30 years ago when I was first getting involved very actively in the investment community and looked 10 years ahead and then had a chance to evaluate my forecast, it would have been pathetic. And if I did that 10 years ago, I would probably be just as wrong as I look back today. But I agree with Lizanne on a couple of major points. First, globalization is here. That's not going to change. But what we're seeing as part of globalization is the increased competitiveness of the United States versus countries that, for cost advantage and other reasons, were able to more effectively compete with the United States. I think, and I agree with her, we're turning back now to where the United States, as I look at over the next 10 years, will continue to be a very, very strong economic power. Many of us, if we think back to the 60s and 70s, recall the Japanese scare. And the Japanese were going to eat our lunch. And I remember when the Nikkei was at 45,000. Now, the Nikkei was the biggest, best performing stock market in the world last year of the developed countries. 45% gain, even better than the United States markets. But by any realistic assessment, the Japanese economy did not continue to grow. The Japanese became much less competitive with the United States. We haven't eaten their lunch. It's still a wonderful country and a very competitive economy. But clearly, we were able to remarshal our resources, rededicate to innovation and industriousness, and we're able to succeed. We have certainly the best secondary education system in the world. And I think that education system, combined with the resourcefulness of the American people, will allow the United States economy over the next 10 to 15 years to continue to excel. I think there'll be increased complexity of financial product, just as there's been the past 10 years, the alternative investments that Lizanne alluded to. But by and large, I think the United States will be very, very importantly a key component of a well-diversified securities portfolio and investment portfolio for you.
Okay, Paul, you're up.
Well, given that I focus on the governmental and policymaking side of things, I will provide the gloomy perspective, not to disagree with anything that's gone before, but if you look at the policymaking environment in which investment takes place, there are some pretty serious dysfunctions that I think are going to play out potentially over the next 10 or 15 years. If we look at the current Congress from a historical perspective, it's been an historically unproductive Congress, and both substantively and just in terms of number of bills passed. Now, some might argue that the best government is the one that governs least, but the dysfunction of Congress is to the extent that even some routine legislation, for example, there are tax breaks that Congress allows to expire every year and then retroactively installs, which makes financial planning difficult for people who are looking at those tax policies. That's a symptom of a broader phenomenon that's going on in Washington right now. And there are various reasons for this. The biggest one is political polarization. The two parties are more and more unified within themselves, but there's less and less overlap between them. And that makes things difficult, especially in the situation we're in right now with divided government, where one party controls the White House and the Senate, and another party controls the House. You might remember the government shutdown from the fall, which is a symptom of this broader political issue. Now, the next big way that this is going to play out will probably be a fight over the debt ceiling next month. Now, I don't want to be too alarmist. I don't think that the government is going to default next month. I think that there will probably be a lot of talk about this. The Obama White House will refuse to negotiate. Some hardliners in the Republican Party in Congress will make demands for raising the debt ceiling, but the GOP's political strategists favor getting this off of the table, and they think that the political climate for them is good right now, so they don't want another big battle like the government shutdown. But in broader terms, the two parties in Washington are having a very hard time compromising and finding solutions for problems that the country is facing. Now, there are areas of potential hope. For example, after being dead for a while, there are at least signs of life for comprehensive immigration reform. There's support for it in the Senate. The House is the big question. This is a policy area where the business community in general, the U.S. Chamber of Commerce in particular, is strongly supportive of doing something. But whether that comes to pass is something to keep an eye on in 2014 to see if this is a Congress that can actually get things done or not.
Okay. I'm going to move to some of the questions that students here in the Lerner College submitted. The first one from Joe Francolino of Staten Island. I'm going to read his question and then broaden it a little bit for all of you. I'd like you to take a little broader perspective. Joe's question was, what circumstances cause you to rely more heavily on your instinct rather than on statistics in asset allocation? And I'd like to just broaden it to say, I think that's an interesting question about when do you resort to making decisions on the basis of data, hard facts, this is what's crossed my desk this morning, and so on. And when do you just say, you know what, it doesn't feel right, or this does feel right, even though everybody's saying something else is right. Mm-hmm. And I think this applies both in the investment and financial community as well as in the political community. Liz Ann, you want to tackle that?
It's such an ironic and interesting question to have, and I saw this, as you know, before getting here. I'm giving the commencement address on Sunday. My entire commencement address is about this subject.
Joe, are you here? Joe, he gets an A. Okay.
And not because I got Joe's question and just started to write my commencement speech yesterday, but I am a huge believer in the power of gut instincts. That doesn't mean that I don't ever rely on data. I think that has to be a part of it. But the theme in the commencement address I'm going to give on Sunday is about the benefit of sort of, I called it feeling that kind of twang in your gut, or almost hearing that clang in your head, where something is either not right or you feel like you're at that inflection point. And I think the whole concept of inflection points is crucial to think about. Whether you're a market analyst, you're trying to figure out economies, you're trying to understand why sometimes the two don't seem to make sense, which I get a lot of questions about that. How can the stock market be up 180% in the last 4.5 years when we're still sort of languishing and 7.5%, well now 6.7% unemployment and problems still in Europe? And it goes to the relationship between the market and the economy, but much more broadly to the notion of inflection points. And I think if you think about an inflection point, whether it's in the stock market, whether it's in the economy, whether it's in our own lives, when things, sort of negative inflection points, when things stop getting worse and start to get better. But think about that moment where you're at the bottom of the V. You don't have the benefit of knowing that you're at the bottom of the V and that this is coming next. All you know, and you then know in hindsight, is that that's the absolute worst time. And that's one of the things that I think investors miss from a market perspective, is they still can't figure out how the stock market could have bottomed in March of 2009. The first quarter of 2009 was the single worst quarter for the economy. Things were absolutely horrific, but the stock market looks ahead. It's sort of that gut instinct that says, you know what? It's stopped getting worse. It's going to get better, and it launches off that inflection point. And I think figuring out those inflection points has more to do with gut instinct and that feeling you get, and that, you know what, it's the reason why the Warren Buffetts of the world and the Sir John Templeton of the world coined phrases like buy when there's blood in the street, buy when everybody else is selling. It's that point, and I would almost tie it to the political situation. When you get a congressional approval rating to 6%, which, by the way, can't even add up to friends and family, I marvel at the 6%. I would love to meet anyone in the 6% that thinks Congress is doing a bang-up job, because I think it should be 0%. But you got to think at some point the bar gets set so low that there's simply just no more room under it. And that's where the gut instinct has to come in, because the data can sort of support that, and you need that data support, but figuring out when you're at that turn, and it happens in our lives, it happens in the economy, it happens in markets, and I think at those crucial turning points, your gut is more important than the data.
Okay. Don?
Well, I think it ties to experience, too. I think when you're younger, and especially when you're first coming out of school and you learn all these wonderful quantitative techniques, you feel like you have to apply them to large data sets, and you actually believe that there's something to it. And many times there is. But I remember many years ago, a very good friend of mine was a senior official at the Philadelphia Federal Reserve. And the Fed has some of the greatest minds in the world to do analysis of data. And I said to him, given all this resources and given the brain power, you guys can't forecast worth a darn. And he says, you're right, and it's the nature of the models. The standard error from a statistical perspective is so great, it swamps the ability to have confidence in a very definitive forecast. There are times when the reliance on the quantitative analysis has really contributed to the collapse, especially in 2008. If you look at some of the risk models that the commercial banks use, and I don't want to mention any particular banks because some of them are clients of ours, and it gets a little bit touchy, but they all use value at risk. They all use very sophisticated techniques to measure the risk exposure in their portfolios, and they all got their clocks cleaned. There was nothing wrong with the models per se, but the models are, of course, based on historical data. And there's limitations to the validity of those models when there's dynamic changes going on in the system. And at those times, I think you just have to sit back, whether you're Jamie Dimon or Vikram Pandit or whoever, and say to yourself, something just doesn't feel right. I understand what the models are telling me. I understand what my portfolio managers are telling me, but something just doesn't feel right. And if more challenges were made in that way to these models, I think we would have significantly reduced the risk exposure that eventually led to a significant, the Great Recession that we had.
Well, to build on what Don's saying, I'm a big believer in numbers in general. My research is based on statistics. It's the way that I think about the world. And certainly going forward, you hear more and more about big data. It rules sports now, it rules politics. But I think there's widespread statistical illiteracy among the public and in high places, and that extends to these kinds of decisions. I think one of the big issues, building off of what you said, is in applying statistics and quantitative data to beware of exaggerations of certainty from results. Mm-hmm. So we live in a country that worships data, and so people plug in these numbers to the models and they get results. And they can give you results that look very precise. But often the uncertainty involved in the assumptions behind those models is quite great. And it's easy to interpret patterns when those patterns may not actually mean anything or may reflect spurious correlations. So there are lots of numbers out there, and I think they're very, very useful. But I'd just be very cautious in applying them with false certainty.
I want to follow up, but just briefly, from a student's perspective, if I were a student sitting in this room and I saw three highly experienced people, and Don, you made reference to the fact that some of it has to do with experience, and of course that was implicit in your remarks as well too. How is a young person just graduating, looking ahead to the next 5 years or so in this investment world, where do they get the gut? Where do they see the gut? What would you advise them to do? Emulate someone else? Where is it that they can get a feeling of what that's like to say, yeah, it just doesn't feel right, or yeah, I'm going to pick this stock or make this move with my limited funds because it feels right? Maybe just a couple words on that?
Yeah, I think the true gut instinct does come with experience, and you're gonna feel it and have success with it more in your field of expertise and study, obviously. But yeah, attaching yourself, being mentored by somebody that has proven to be particularly adept at that's what happened for me. I was very blessed to work for a gentleman named Marty Zweig for my first 13 years in the business, who was as iconic as they came in the world of Wall Street in the 1980s, and was extremely famous, best-selling books, had started one of the first hedge funds in history that's still ongoing. And it was, I was at the firm less than a year. It was the Friday night, October 16th, before Monday, October 19th, the crash of '87. And the show, Ralph, that you referenced, Wall Street Week with Louis Rukeyser, which most of you are too young to remember it, but it was the only show about Wall Street on for decades before CNBC came around. Friday night on PBS, 8:30, 5 million viewers. And Lou asked Marty, who was a regular on the show that night, so you sound particularly bearish. Do you think we have a bear market? He said, no, Lou, I think the market's going to crash next week. And he proceeded to then lay out what he thought would happen. I think it'll be a big whoosh down. Then we'll have a couple of fierce rallies, but we'll retest the low once or twice, and then from there we'll be off to the races. And that is exactly what happened. So I'm at the time 22 years old, and I'm thinking, well, it's easy. You figure out before that the market's going to crash. You take all your money out, and then when it does crash, it's cheaper, and you buy. What's the big deal? Little did I know, it's a huge deal and very difficult to do. So for me, I had the personal experience of somebody who learned to use the gut. And I thought, all right, well, he's got something. And it's not just what's on paper and in the models. And I glommed on to that. And that's where I learned a lot of that gut stuff.
You both don't have to respond on this if you
No,
don't
but
want to.
one of the things, of course, that's going on in the world today is an abundance of data, if not of information. And there's so much available for you to read, for you to study, much more than when Lizanne or me many years before that were coming up. And you can get overwhelmed with that. But I think it's important to read. I think it's important to look at data. I think it's important to stay knowledgeable about world events because they all affect the financial community, of course. But I think it's also very important to have a mentor. Lizanne had Marty Zweig. I knew Marty when I was a student at Michigan State, and he was a wonderful person as well as a very, very brilliant financial mind. But there are mentors, and the person you have as a mentor is not necessarily the person you get from day one and stays with you your whole life. You will change mentors over time. You may learn all you possibly can from a particular person. It's time to move on. It may mean moving to a different company. It may mean moving to a different position within that company. It may be the person you've latched onto is the wrong mentor, and it's time to move on to somebody else. Those are decisions you have to make, but I think the mentoring process, the communication process, the knowing people process, which we tend to lose sight of in this world of Twitter and tweet. I don't do any of these things, I'm sorry. I do email, which is, saying something for me. No, I won't. But the personal contact and the relationships are still very, very vitally important. And whether you're in academia or in business or in finance, the mentoring process is critical, and you need to be able to identify that and get as much at it as you can out of that relationship. And that's how you learn. That's how you learn. And you can't be afraid to make mistakes. And one thing about the world of investments, I assure you, more than half the time, you're going to be wrong. That's just the way it is, and you move on.
Paul, did you want to?
Yes, yes. Actually, one of the things I'm interested in is what exactly is the gut? I'm sort of interested in the psychology of what goes into the gut. And the way I think about the gut is it's actually a series of rules of thumb, shortcuts, heuristics, psychologists call them, about decision making. Because like you said, there's more information out there than you will ever be able to use. It's just an overwhelming tide. And so you won't use it all. People aren't calculators. That's not the way that they actually make decisions, even if they look at the models. They make it based on their gut. But the question is, what goes into your gut? And the challenge I would give to you is to look into your gut and figure out how exactly does your gut work? What rules does it actually follow? How do you actually make those decisions? And try to teach your gut to be a smart gut.
Very good point.
Okay. All right, I'm going to turn to a question from Alex Clark of Haddonfield, New Jersey, whose question is, in my view, one that bridges the arena of business and finance and public opinion and governance. Given that consumers make up 70% of the economy, how do you plan to address the looming increase in the federal funds rate, which will have negative impacts on individual discretionary spending, as well as companies' estimated future cash flow? So consumers are vitally important here, big factor. How do you address what's happening to consumers and consumers' feelings about the market, about the future of their lives, about the future of their spending and their savings? Roseanne?
I would say that the environment that caused Fed funds to go to 0% in 2008 was much more damaging to consumer and consumption than an environment that suggests that rates start going higher. First of all, if you're talking purely about the cost of borrowing, that's more tied to long-term interest rates, not the Fed funds rate. But an environment that has the Fed finally moving toward normalizing monetary policy, taking out of this environment of ZIRP, zero interest rate policy, is one that the power of that in terms of the economy, where we're likely to be in terms of job growth, employment, is going to be so much more powerful a positive force than the impact of the Fed funds rate going from the range where it is now from 0 to 25 basis points to 2-3%. Believe me, you want to pray for an environment where the Fed funds rate is going up, because it's a heck of a lot better an environment for the consumer than the one we have been in the last 4 years.
Well, I think Lizanne's absolutely correct on that. First of all, the Fed funds rate isn't going to go up sharply in the very near term. The Fed's made it quite clear, even with the unemployment report today at 6.7, that the job market is just not that good. It's improving, but it's not that good. So I don't see short-term rates coming up really anytime soon. And as Lizanne pointed out, it's the long-term rates that are critically important. Those are the rates at which ultimately corporations are going to be borrowing at if they want to properly fund their balance sheets. And those are the rates that consumers are going to be paying if they want to be into the mortgage market. There's a report out today that there's concerns about mortgage origination slowing down because of the rise in rates. I find this pretty absurd myself, because years ago when I was at the Federal Home Loan Bank Board, I was doing research on the mortgage markets. The major category of mortgages in the United States had 8% coupons, 8%. Now, there may be one other person in this room who can remember back to 1981, other than me. But in 1981, long-term rates, mortgage rates, were 16% in the United States. Now we're talking about, even with the rise in rates, mortgage rates are 4%, for crying out loud. I don't see that discouraging construction and home buying and home building, provided the overall economy continues to improve. So the short-term rate, to me, I agree. To me, the 0% rate, it's time to move on, because to me right now that's damaging, because if you're looking for income, you can't get it. So the growth in the economy that would justify the higher Fed funds rate, I think, will also be indicative of perhaps longer rates. I wouldn't be buying long bonds right now. But overall, the general growth in the economy is going to be much more beneficial to this country and to our financial markets than is some concern about an increase in the short end of the curve.
And will the consumers see that or feel that?
It's going to be a long time before the consumer has any negative impact from this. Again, the mortgage rates are sufficiently low that the cost of home buying and the monthly payments are just not that severe. Most credit card rates, to the extent you borrow, are at such a fixed spread, a wide spread over the short-term rate. It isn't the short-term rate that's causing the cost of funds to be a problem. It's that spread you pay over that rate. So the consumer, to the extent they're going to feel rising rates, in some respects, they're going to benefit from it because they're going to get higher rates on their savings, where we're getting 0%. If you have a money market fund, you're literally getting zero. So I think the consumer is not going to be negatively affected by this, and in many ways, the consumer, especially with the growth in the economy and continued strengthening of the jobs market, should be able to benefit. They will not be hurt by this.
Paul, do you want to?
Nothing really to add. I think they've done a good job of putting that into perspective.
Thank you.
Okay. Now, so we've talked about the Fed's rate, and the other topic that Lizanne mentioned in passing in her very first remarks was the unemployment rate, which until today was above 7%. Now it's, I think you said 6.7 today. But maybe let's talk for a minute about unemployment and how that affects public sentiment and how it affects the industries that you're in. The student, whose name is Xiang Hu from China, is asking, what do you think about unemployment? And she poses this question: if 7% is too high and 0% is impossible, what's a reasonable percentage for the public to look to and say, things are getting better, or things feel good, or we're okay?
Let me make one comment first about the unemployment rate and its relationship to the economy that I think gets lost in the analysis very often. In economics, there's the concept of leading indicators and lagging indicators, and by their name, the leading indicators are the ones that tend to move first. They're heads-up indicators. They move before the economy moves. I mentioned that the stock market is one of those. The stock market almost always has its move first before it's confirmed by the economy. The unemployment rate is one of the most lagging of all economic indicators. In fact, think about it. Just using the most recent example, and I wish I had a chart to put up here. It's one of those charts where I wish I had in my pocket all the time, because investors, people who analyze the economy, who use the unemployment rate to think about, is the economy strong, is it weak? The stock market doesn't make sense because the unemployment rate is high or low. Miss this whole lagging nature of the unemployment rate. I don't know the exact numbers, but when the stock market peaked out in October of 2007, the unemployment rate was 4 and change. When the stock market bottomed out in March of 2009, and then the recession ended in June of 2009, the unemployment rate was over 10%. So think of it this way. If you were going to think of the economy like it was a stock, and you had two choices, you were either going to buy the economy or short the economy, and you were using the unemployment rate as your only indicator of when to buy and when to sell, you would want to short the economy when the unemployment rate was at its absolute low point, and you'd want to aggressively go long the economy when the unemployment rate was at its absolute high point. So it's that whole notion of inflection points. At the economic inflection point where things stop getting better and they start to crash, that's usually when the unemployment rate is at its absolute low point. The point is, not so much be careful what you wish for. I'm not here saying we should all hope for a 10% unemployment rate because then everything's hunky-dory in the economy. Of course not. But understand that by the time the unemployment rate gets to where we're all going to feel fabulous about it, I don't know if that's sub 5%. I think there's demographics and issues that help to explain why labor force participation is going down so much, why the unemployment rate has been doing kind of these funky things it's been doing, like today, very weak job report, yet a big drop in the unemployment rate. Just understand that by the time we get to that point, we are probably on the verge of the next recession because it is such a lagging indicator. So what was interesting about the number today is job gains of only 75,000, which was much weaker. The whisper number into this morning was 200,000 because of a strong ADP report 2 days ago. But the unemployment rate dropped from 7% to 6.7. So a lot of people are saying, I don't get it. Fewer jobs created, yet a big drop in the unemployment rate. The labor force participation rate shrunk again. Now, the negative Nellies out there will say even more people have given up because they can't find jobs. I'm a strong, firm believer that at least half, and I would argue maybe 70% of the reason why that's happening is demographics. People are retiring. And you know what? They can now. 401k balances are back well above their 2007 highs. IRAs are back above. You look at all of the surveys, and we're at that point now where people are saying, you know what, I'm done, I'm retiring. The age wave tells you that. So that's why you had a funky report like today where you get the big drop. In terms of what that means for the Fed, to tie it into the last question, I don't think it means anything. Some people say, oh no, the unemployment rate's dropping quicker than expected. The Fed is going to be forced to tighten more quickly. Yet the job growth was weaker, which means, are they going to actually stop tapering and do more quantitative easing? I think in reality, it probably nets out to they'll continue on the same path that they have been. But understand that I truly do believe by the time we get down to maybe 5% or so on unemployment, we may be already in the next recession.
Don, you want to comment on
Well,
that?
I'm not sure we can get down to 5% unemployment anymore because of the technological change. I agree the drop in the labor force is certainly contributing to the fall in the unemployment rate, and I think the relevance of the unemployment rate, I would agree with Liz Ann, is just not as important as it once was. But the technological change is going to make it very, very difficult for structural unemployment to be reduced much below 6%, 5.75%. I don't see it going to 5, and I certainly don't see it going back to 4 unless there's a massive shrinkage in the pool of people who are seeking employment.
What do you mean by the technological change?
Jobs that can be done by other than people, that there's a substitution of technological usage, equipment, factory. I was, one of our clients is R.J. Reynolds, the tobacco people. We have nothing to do with tobacco, so please don't, criticize me for this. We're only involved in the finance side of the business. But I went down to Winston-Salem and visited they only have one manufacturing plant in the United States that produces billions of cigarettes a year, obviously. In that plant, I don't think there's 100 people working in the entire facility outside of the office. Everything is mechanized. Everything is mechanized. And most of the people you see working in the plant are looking at computers to evaluate the quality control of the production process. Years ago, one of our clients was LTV Steel. Unfortunately, they went bankrupt. I had nothing to do with that either. And again, if you went to the plant and saw the number of people working, it's just not that many people given what the output is. And with further advances in technology, the need for a lot of the traditional workers for those what were labor-intensive jobs is just disappearing. Our governor has made a very, very good point. We need to somehow deal with the chronic underemployed and unemployed. And we do have people, unfortunately, in this country who are chronically underemployed and either because of education or for other reasons. And we as a country need to address that. And I don't think we're doing a very good job of it, but we're aware at least that we need to address it. And perhaps
Can I
Paul.
make one
No, sure.
Yeah.
comment on the other side of that? I don't disagree with anything you said, but I think the concentration of where technology means fewer workers is in yesterday's and traditional manufacturing.
Yes.
If you look at tomorrow's manufacturing, you look at robotics, artificial intelligence, 3D printing, what's going on in fracking and shale and petroleum refining, a couple of points. One, the number one problem they say they have right now is finding skilled workers. They've got jobs, they don't have the skilled workers. So I think we're in a gap right now where you look back at traditional manufacturing and it is being overtaken by innovation and productivity and technology. Tomorrow's jobs are there, we just don't have the skills for them. So we're going through a gap period where education and training has to be adjusted. But the good news is many of these industries that are the booming industries right now have huge jobs multipliers. So what is a jobs multiplier? The way it's typically done is they look industry by industry, and you say for every 100 jobs that your industry creates, how many jobs does it create elsewhere in the economy? In other words, what's the ripple effect? So things like construction and retail all have sub 100 job multipliers. So if the retail industry broadly creates 100 jobs, it creates like 80 other jobs in the economy. Very few ripple effects. Petroleum refining is at the top of the list. For every 100 jobs created by petroleum refining, 1,200 jobs are created elsewhere in the economy. So you think about places like North Dakota and the Bakken Shale, and the ripple effects into housing and retail and hotels and restaurants. So that's where I think the opportunities are, but we have a massive skills gap right now, and that's a ocean liner. That's not a speedboat. That takes a long time to shift. I think we're doing it, and I also think it has implications for young people who are thinking, what do I do in the next 10 to 15 years? You need to sort of look ahead as opposed to look back.
I was actually going to ask you to come back to your original point in your opening statement when you said we're heading toward becoming a manufacturing power again in the country. But you're talking about a different kind of manufacturing with young people with different skills filling those positions. And that has bad implications for those of us who either don't have the skills or who are at the end of our careers and have lost our jobs in this higher unemployment period. We're not likely to get picked up again.
That's the dislocation piece of this, absolutely. And I think that the sort of disassociated workers that either don't have the time, the energy, the financial wherewithal to search out that additional training, they're the ones that are going to be lost in this transition period.
And I agree with Lizanne, and we cannot afford that as a country. We just can't afford that.
Yeah, just
The
a,
unemployment figure has a lot of effect on public opinion.
yeah, just a final comment, kind of to come back to the unemployment rate and make a broader point, which is I think one broader lesson you can draw from the commentary here is that the way that the economy gets talked about, especially in the news, and Ralph, you're a former journalist, so feel free to disagree with what I'm about to say here, is the unemployment rate is something that it's very easy to tell a news story about. The arrow went up, the arrow went down, this number of jobs lost, this number of jobs gained. And so it's a very intuitive way to tell news stories. It's a very intuitive way for members of the broader public to think about the economy. And it's a politically important statistic because politicians, rightly or wrongly, get blamed if the economy is seen as losing jobs. They get rewarded if it gains jobs. They especially get blamed if the economy loses jobs. But the way that the economy gets covered in the news is a fairly simplistic kind of story because the news, first off, the journalists have to understand the economy themselves to be able to tell stories about it that are useful, which sometimes happens and sometimes does not happen. And then there are constraints that the news media face in telling stories about the economy. So I think the broader lesson here is to look beyond the indicators that the news media like to talk about a lot and think about the implications of that for the political implications and the news storytelling implications versus the investing implications.
I remember years ago, the hot button item before it became unemployment was the money supply.
Oh, yeah.
And every Thursday, the money supply would be reported, and the news journalists and all the news media would follow it. And there would be an immediate reaction to whatever the number was versus the expected number. No one talks about the money supply anymore, and I don't think they've talked about the money supply for 15 years. Now, I'm not going to say that's going to happen to unemployment rates, but there can be a myopia amongst people who are getting information from news and other sources and attribute perhaps more significance to that data than the information content merits.
Paul, to what extent do members of Congress who are making decisions about things like tax policy and approving or disapproving new Fed chairman and so on, are they paying more attention? Are they paying attention to the same shallow statistics reported by the news media?
Well, they have to pay attention to both, to the extent that they pay attention to information. Because the news media talk about unemployment and because their voters care about it, they do have to pay attention to it. So that's one of the things they have to factor into policymaking. And we see this right now with the debate over extending unemployment benefits, which is very politically controversial. Right now, the Senate just recently passed, somewhat unexpectedly, they got 60 votes for a 3-month extension. What big picture difference a 3-month extension is going to make, I don't know, but the House may not end up passing it anyway. So it's very politically important.
Here's a question from Christina Perricone of New Fairfield, Connecticut. And this one takes us back to a student perspective. Are there certain investing strategies or kinds of companies that are better suited for young investors? And more importantly, she says, what characteristics of these strategies and companies make them more appealing or more attractive or appropriate for young investors? And now we're talking obviously about people with not that much to invest, but who are thinking about getting started soon after they graduate.
I love this question, and I get it in so many different forms, whether it's somebody that's younger saying, what should my asset allocation look like? How should I approach investment strategy versus somebody older who might ask the same question, I'm 5 years from retirement, and so what should I be doing? It doesn't matter. What matters is who you are as an individual and what your tolerance for risk is. Let me give you a couple examples. You could be 22 years old, just starting to work, investing in a 401k. You go bungee jumping on the weekend, very high tolerance for risk. You are not going to look at your portfolio every quarter and freak out about it. To that investor, I say, be totally aggressive. You don't need the money. You want to get the maximum amount of gain. You're not going to freak out and panic at lows. Versus say, are you 70 years old, you're already retired, you need every single dime you have and you need to earn income on it, and you have a habit of panicking when the market goes down. I could have the most high confidence view of what I think the market is going to do, but what I would tell those two investors to do would be two completely different things. You can reverse it too. You could find a 22-year-old who is just by their personality going to panic, and they're going to say, "Oh my God, the market's down and the unemployment rate. I'm out. I can't handle it. I can't take the risk." I had the great pleasure of meeting Sir John Templeton, who at the time I was about to say before he died, as if I met him after he died. Obviously, I met him before he died. But he was 92 years old when I met him, and he was talking in the green room before a TV show I did with him about how aggressive an investor he was. Clearly not because he had lots of time ahead of him, but he knew the risk. He was willing to take it. He was comfortable with the risk. He had a couple $2 billion. That helps too. So it's understanding your sort of own internal proclivities that are more important to than how you should invest. There's no one right answer. Well, you should buy a growth stock, or you should, and the whole Peter Lynch thing, buy what you know. If you see lines at Starbucks, you should therefore buy the stock. That's a ridiculous way to approach investing. But the first thing is look inside and say, what's my tolerance for risk? Do I need the money? What's my time horizon? Establish a plan, and from there, then you figure out what investments make sense.
Don, some advice for?
Well, one of my early mentors was a fellow named Harry Sauvain, which I'm highly confident nobody in this room has ever heard of. He was a very distinguished professor of finance at Indiana University. He passed away many, many years ago. Harry was to investment management, which was the title of his book, what Graham and Dodd were to securities analysis. Harry just didn't believe in the usefulness, and this is before, and Harry didn't know what efficient markets were or any of this. He really didn't see the importance of securities analysis of individual stocks relative to the importance of overall investment management. And he had a very systematic approach to going through a series of questions that got to your ability to accept risk, what you were saving for, what your goals were. And with all of that information, you constructed a portfolio and you developed strategic asset allocation, which is really what Liz Ann has said and what she's done and what she tells her client base. To me, the question of which stocks, and I hear these questions all the time too, that's really putting the cart before the horse. You really need to develop some sound policy for yourself, and it's unique to you. There is no one-size-fits-all investment strategy. It really has to be unique to you.
The lines about the Starbucks, to get back to what I said earlier, that would be an example of a dumb gut. But I'm going to punt on this question, because if you're asking for advice on whether to invest in a bridge that Chris Christie wants to sell you, I'm comfortable doing that. But broader investment strategy is kind of outside my field.
All right.
That was good, wasn't that?
I went to college. I went here with him, by the way.
And his wife, not
Mary Pat.
Mary Pat went here too.
Mary Pat was one of my
Yes.
students. I had her in a couple of classes. Now, maybe she thought
I
that
had
when
him
she was
at a-
in there, maybe she
both of
thought
them
I
at
had
a couple
already
of
died.
parties at
Yes.
Stone Balloon.
We probably met before then. Yes.
A lot of the questions that were asked in advance of today's session came from students in the Lerner College. And I was looking them over the last couple of days, and I know they were shared with our panelists. I feel that there's some areas that they didn't cover that I think we should at least touch bases on here. For example, I think that public attitudes about Wall Street played a role in the last couple of presidential elections. There was the whole Main Street, Wall Street thing, and this happens all the time. I'd like to ask you all to comment on whether public opinion about the business and financial industry, the Bernie Madoff scandals, the various scandals, it's not just him, but there have been so many of them now. What effect does that have? And what effect should it have on young people as they think about these kinds of careers and these kinds of investments? And the mirror image as well. What about Wall Street's opinion or view of what goes on in Washington? Whether it's resentment about Obama's criticism of Wall Street, or whether it's a sense of camaraderie, if there is one, with a certain candidate, maybe with Mitt Romney in the last election. Let's talk a little bit, if we could, about that relationship of public opinion, attitudes toward Wall Street, and Wall Street attitudes toward Washington.
Let me start with the second part of your question, which is Wall Street's attitudes towards Washington, and maybe not just Wall Street, but business more broadly. There's a lot of different surveys that are done as to what sort of plagues you most, and I think the one arguably more important these days, and maybe at any time, are the surveys of small businesses, because they're the biggest job creators, they're the biggest needle movers in the economy. And for the first time ever, within the last couple of years, public policy uncertainty has been the number one reason why they are feeling pessimistic. So it's not weak demand, it's not sales, it's not the obvious things that would typically plague a business. And what you hear from business leaders, and you will hear it from a business leader that is on the far left side of the political spectrum, and you will hear the exact same thing from a business leader on the far right side or somebody right in the middle, which is, at this stage, it almost doesn't matter what the rules are. I just actually need rules. So it's the uncertainty factor. It's not, someone on the right is going to say, I think there's too many regulations. Someone on the left is going to say, we got to tax higher. So you're going to get, but they're also saying, you know what, I'm not even going to bother putting the uniform and going out on the field because I have absolutely no idea what the rules of the game are. I think for the financial services in particular, Dodd-Frank, a year ago was only 30% written. It's one of the biggest pieces of regulation, only 30% of the rules. We're now at about 50%. And we have years ahead before the rest of the rules are written. So we know we've got this big regulatory structure coming down on the industry. We only know what half of it is. So you can hear all the infighting, they shouldn't do this, but just give us the roadmap here. We can operate under any tax situation, under any regulatory environment, but we need to know what it is. So that, I think, as far as the opinion that people have on Wall Street, it's not great. It's better than it was in 2008 and 2009. You know, Martin Scorsese doesn't help much with, and I lived through, I remember that environment. I remember the guy. He didn't look like Leo DiCaprio, but I was actually with both of them, ran into them in Bloomberg in the green room in New York City, which was very cool. But I think it's a lot better than it was. But it's I mean, when I started in the business, this was pre-crash of '87. This was the first Wall Street movie, not the one most of you know, but the original Gordon Gekko movie. So there was this aura about Wall Street. It was just a cool place to work. And you got that again in the late 1990s, less so in the last upcycle because it was more about housing. I don't know that we ever get back to those sort of go-go days again, but we're healing from where we were a few years ago.
If students in this room are thinking that's a cool place to work, what would you say?
I still think it's a really cool place to work. And if anything, inflection points, you ought to maybe consider the industry again, since it's probably closer to its low point than its high point.
Okay. Go ahead, Don.
Paul had mentioned earlier about the uncertainty and its impact, and Lizanne has said the same thing, and they're totally correct. It's really hard to make decisions when you don't know the rules of the game. And the rules, not only don't you know the rules, whatever rules there are seem to be changing every day. I'm very actively involved in a sliver of the overall financial markets called collateralized loan obligations. We package commercial loans and sell these packages to investors. If you sat in my office for a couple of days and went through the emails for one transaction and saw the revisions that are going on because of the changing view of what Dodd-Frank's implications are, of what the Volcker rule is, of what the international capital standards are, as to whether, and this is part of the uncertainty, commercial banks, which are the major buyers of the AAA securities piece of these structures, can even buy them anymore, and if they buy them, will they have to sell them in a year? And if you go to the regulators say, well, we'll take another look at it, but you already made a rule, but you're going to take another look at it. What does that mean, you're going to take another look at it? There's a tremendous cost on the system, and I don't think there's an appreciation amongst either regulators or legislatures or the administration in Washington as to what that cost is. And I will tell you that those of us putting these deals together, we're not going to have that cost come out of our pocket. We're passing that cost along to other people, the investors, which are all institutions. But ultimately, the consumer is paying for this uncertainty, this ambiguity of the rulemaking process. I've never seen it in my 40 years of doing structured finance. I've never seen the situation as bad as it is today. And I quite honestly don't see this getting any better in the near term. The uncertainty is just a very expensive, very bothersome process. The other part of the question had to do with the vilification of Wall Street, and many of us feel that. I think it's just, were there some bad actors from 2007, 2008? Yes, there were. Were there more bad actors there than there were 15 years ago? I really don't think so. I don't think there were bad characters in the 60s and the 70s, the 80s. Most people that we deal with have extremely high integrity. They play by the rules to the extent they can understand the rules. They're fair, they're honest, they don't cheat. Given the profit margins we deal with, we don't need to cheat, perhaps. But most people do play by the rules. There are some bad characters, and unfortunately, they're the ones who make the front page, and the whole industry gets tarred and feathered by this. And it's really unfortunate that that's the case, because there are just so many people who, there have been far more bad business decisions and investment decisions than there have been unethical decisions. Most of, to me, the crisis of 2007, 2008 were just bad business decisions, not unethical decisions at all.
I'll talk about public opinion.
Yeah, I guess in terms of the public image of Wall Street and business more broadly, I kind of see it as an ambivalent one, like with attorneys. On the one hand, you ask people in polls what they think of attorneys, they say pretty negative things. You turn on the TV and there are all these shows about attorneys and their love lives. It also depends on how you ask the question. If you ask people what they think about big business, you'll get pretty negative answers. If you ask them what they think of small business, which you're talking about earlier, people have very much more positive impressions of small business. In terms of the political implications of all this, Bain Capital wasn't exactly a big positive for Mitt Romney in 2012. But looking forward, I think what the interesting thing to watch this year will be is sort of what you could call the Republican Civil War about these sorts of issues, where you've got the establishment candidates largely supporting incumbents, the Chamber of Commerce, and then Republican primary challengers. And I think that the establishment candidates are in all likelihood going to win, and it'll be very interesting to see where this goes forward to 2016, whether someone who's more aligned with the establishment is the Republican standard bearer in 2016, or whether, one of the, I'm trying to think of a word here, someone more like Rand Paul or Ted Cruz ends up being the standard bearer. It's something to keep an eye on.
Another question that hasn't come up in the questions by the students, but I felt is so much in the atmosphere and has been in the atmosphere for the last year or so, and I think among students, it's something that they see as prominent and likely to continue during the time that they're entering the business, is the issue of information sharing or information flows. And I'm not a financial expert by any means or a business expert, but it seems to me the business that you two are in and the business you observe are so dependent, so absolutely dependent on the flow of good information, solid information, reliable information, and dependent on it not being carelessly managed. Mm-hmm. And then we see this now almost drumbeat of stories over the last 3-4 years of information of various sorts making its way out of the places where it's supposed to be and into other places. financial information, personal information, credit cards, social security numbers, government spying on citizens. All of these issues have an effect on public policy and public opinion. What effect do they have on the business world? And looking ahead 10, 15 years, is there something that the business community can help do to, or should be doing, to prevent disaster along those lines?
Well, I think it's had a big impact on financial markets, particularly on given days. I mean, whether you go back to the flash crash in 2010 or more recent, less severe examples where you get, an AP feed that turns out to be wrong and immediately gets shown as wrong and they retract it. But given high-frequency trading and itchy trigger fingers, you can have an impact that is immediate and can be quite damaging from a financial markets perspective. I think we're grasping that these things are more likely to happen, which is why since the flash crash, it's happened to a much less significant degree than it did then. I think that was sort of the first realization. And that wasn't so much a piece of news that came out that turned out to be erroneous. There were other mechanical factors associated with that, but we could see how quickly that happens. I think, I know it firsthand with our firm, the investments that we are making in terms of our data security, cybersecurity is huge. And I think cybersecurity is an issue in politics is growing exponentially, and it is going to be one of the biggest things we read about and care about from a policy perspective.
Is the business community going to be a contributor to solving the problem, or is it going to look to government to fix that
Well,
problem?
I hope it doesn't look to government. I mean, look at the Affordable Care Act. If the government had looked to business, we probably wouldn't, regardless of how you feel about the Affordable Care Act, I think if business had been more involved, we wouldn't have had the fiasco with bringing this whole system online. So hopefully the solution will be in business, or maybe that's my political speech for the day, I don't know. But I'm going to look at a different side to the answer, and I agree with what Liz Ann said. There is so much data and there's so much information. One of the things I think it does do is make the markets ultimately more efficient. Now, I think there are roadblocks along the way, but let me give two simple examples. I'll give one simple example. Municipal bond market. The municipal bond market for years and years was the great unknown. The way the municipal bond market would work is a dealer, we've traded a lot of, I would get a call from the dealer, I'd be shown a bond, I'd be given a quote. God knows if that quote is good or bad, other than my gut feel for whether it's good or bad. But now I can go on a Bloomberg terminal and I can look up who bought that bond, the dealer who's calling me. I know what the dealer paid for that bond. So I know how much I'm going to get reamed on this trade, or at least what they think they can do to me on the trade. And because they know I have that information, they can't do that to me. They have to be much more honest in the pricing. And this is true of more and more securities. The mortgage-backed securities market's still a little bit of a wasteland, but that's improving too. So if we can control the quality of the information and the leakage of information for nefarious uses, I think ultimately the proper use of information and the way we're developing the access to this will make financial markets more efficient, and what that means, they'll be fairer for everybody.
Paul, how about public confidence in Wall Street and government in handling information?
Yeah, I think your question is partly prompted. We were talking earlier about the new target revelations, and I won't get into the issue of who's responsible for solving these sorts of problems. Should it be business? Should it be business and government working together? If I'm not mistaken, part of the reason why there was that target issue in the first place was because kind of a collective failure to update debit and credit card security. I was surprised to read that the United States is actually well behind other countries in terms of that security, because there's been sort of a collective failure in updating the standards of our security systems that other countries have already undertaken. So, but, in terms of what in public confidence in this, I'd be kind of surprised if these sorts of things have a big impact on public confidence just because of the boiled frog syndrome, that these sorts of things are so familiar to the public now that it's really no surprise.
Although I would agree, I don't think the website fiasco with the Affordable Care Act has done much to engender confidence by the public in government's ability from a sort of high-tech perspective. I think if anything, this cemented the notion that at least has to be a public-private partnership when it comes to the ultra-high-tech issues. And
Actually, in support of that, I've seen some recent polling. What's the biggest problem facing the country? And for a while it was business, and now in the latest polling, government's actually
Washington.
past business. The other one they asked about was unions, which, historically just goes,
Not doing well.
well, but they're not seen as a problem because they're
Right.
not.
Well, they're
not important.
They're not important anymore,
Yeah,
right?
it's a non-event.
I'm sure that there's a lot more we can talk about. We're coming to the end of our time here. I want to give each of our panelists an opportunity to make a final comment or a final remark, particularly addressed maybe at students who are here. And you don't have to take this guidance, but we've had several questions from students that I didn't raise, all of which circle around the issue of what was the most interesting or influential course that you took when you were an undergraduate here or elsewhere? What kinds of things should students who are still here be thinking, I've got to do this before I leave because this turns out to be important in retrospect? You don't have to key on that if you don't want to, but
I mean, I'll
final
say
remarks.
the course I remember most was my political science course with Professors Nathan and Oliver. I don't really remember why I liked it so much. I just know 30 years later it's still in my head, so there must have been something good about it because I don't really remember too many other courses. But I would tell you, learn how to speak, learn how to write, learn how to communicate, learn how to think critically. Do not sweat the details of what course is the right course, what textbook is going to teach you the thing that matters most. Most of that stuff does not matter. Keep your head out of the your iPhone and your iPad. Read, be interested, be interesting. Read things, talk about things that challenge you, that are different. We've gotten so myopic in our world, and we're dealing with I watch it with my kids, and it drives us absolutely crazy. We've become sort of very self-focused, and that makes you much less interesting to the rest of the world. But I would say those critical thinking, the ability to communicate, looking people in the eye. When I'm interviewing people, frankly, I couldn't care less what courses they took in undergrad. But if they are engaged and engaging and they can get out sentences grammatically correct without saying like every other word or every other word, if I'm not hearing their text thing go off, if they send a follow-up email, not a text, and it's not all lowercase, all of those things, be mindful of where you get your tattoos, all of those things is so much more important. The collective knowledge we get, whether it's an undergraduate school or graduate school, is absolutely fantastic. But you got to worry about who you are as a person and your ability to engage with the world more than what courses are going to be most crucial.
Don?
I think the tattoo advice was very, very good. I made the mistake, my son got married about a year and a half ago, and at his, the rehearsal dinner, I got up to make some comments, and I said how glad I was that he's marrying this wonderful young lady, and I just have an irreverent sense of humor, and I said something, and I was relieved that she didn't have any tattoos. And then I saw that her sister had them all over her arms, and it was a little chilly evening in the month of May, but, what are you going to do? I think Liz Ann is right on target. Communication skills are critical. Analytical thinking is critical. The ability to write is critical. If I get something in lowercase with these symbols, I have no idea what they mean. I don't read it. I send back, try again. But most people do read quite a bit. Most people are articulate. Most people that I work with have very good analytical skills. I wouldn't get hung up on what you're taking for specific courses, and I know that's easy to say, looking back, and you're in the midst of seeing the trees and not the forest, that's a little bit difficult. But a lot of what you've learned in specific courses, other than general analytical skills, it's going to change so much. When I was in graduate school and in undergraduate school, we learned programming. We had boxes of cards. We learned Fortran. I learned simulation languages. I don't think any of that stuff exists anymore. You can do more on a PC now than what we could do on a mainframe, and we can only get one run of the data set a night. We do it at 3 in the morning, go back the next night. Everything has changed. The accounting I took trained my mind well, but the accounting rules have changed. Now they have so many rules, I don't know what any of them mean anymore. So don't get caught up in all the detail. What you really need to do and what's going to last you a long term are these more general good skills. The best skills I learned, I thought, were really in the humanities. The people I took classes until I went on for graduate study in business and in finance at the doctoral level, really were in the humanities and in the social sciences. They did more to train my mind and my ability to think and my ability to write than most of my business courses did. Not that the business courses didn't help train my mind and aren't valuable today, but at the undergraduate level, it was really something other than the business courses that I remember most today as having some significant influence on my thinking.
Paul, final word?
Yeah, one final thing I'll add to that is one regret I have about my undergraduate days is that I didn't do more study abroad. And we've talked about how important the global economy is to the future of investment. And getting an enriched perspective on that, I think, is very valuable. And UD has an excellent study abroad program, so I would certainly recommend that to you.
All right, and as we wrap up, I'd like to ask Dean George Watson of the College of Arts and Sciences to step forward for some closing remarks. And before he does, let's please give our panelists, Don Puglisi, Paul Brewer, and Liz Ann Saunders, a big round of applause of appreciation for their time. Dean Watson.
My remarks really are brief. I just wanted to express some appreciation to a few different people. This has been a real treat. We've been working on enhancing the programming during winter session for the benefit of our students. I think this is a perfect example of that, Jeff. I think, right? Maybe this is the beginning of a tradition, I don't know. If you were a student who submitted a question, whether it was asked or not, could you just stand and be acknowledged? Come on. Come on.
All right.
Oh, all right.
Clearly, Ralph had synthesized some of your questions to what's here. I wanted to extend appreciation to Ralph. Ralph's on a very well-deserved sabbatical leave this year, so he's here as a volunteer. He hardly ever says no to anything. Liz Ann, congratulations on your honorary doctorate that you'll be getting on Sunday that goes along.
After which you will all call me Dr. Saunders. And nothing else, including my kids.
Doctorate in business.
Don't count your chickens before they're hatched. Sunday.
It's not in my hand
That's
yet,
right.
I know.
But the time you spent with the students earlier and just anchoring this panel really goes above and beyond what typically the commencement speaker offers.
Oh, they made it sound like this was all mandatory. Good job.
Don's a very distinguished emeritus professor, and you can see why he's kind of legendary here. I never had a chance to hear Don speak about his professional part of his life. He's been very generous with his time and his success, so I really appreciate your engagement with the university. Paul is kind of new to our campus. When you think about the kinds of investments that deans make investments by hiring faculty, and I think Paul is one of my smarter investments, and I'm really pleased that you're the only one of the four who maybe was obligated to be here this morning.